Imagine waking up and realizing the Federal Reserve just moved this single number, and suddenly Bitcoin, Ethereum, your entire portfolio either pumps like crazy or falls off a cliff quickly. Sounds dramatic, right? But that's exactly how strong interest rates are. And today, I'm breaking down how the Fed quietly controls the entire crypto market. So here's the truth. When interest rates go up, money gets expensive. Investors pull cash out of risky assets, and crypto is usually first on the chopping block. But when rates start to drop, liquidity floods back in, risk appetite returns, and when crypto wakes up fast, then the whole economy is ready to pump the market back up. Let's go on and jump into the reasons why interest rates are so important for the crypto market. Fed rates, they're extremely important. Let's go and let's understand the macro forces and how central bank decisions move the digital asset market. So the engine, the Federal Reserve policy. The U.S. Federal Reserve, which is the Fed, it operates with the dual mandate, maximizing employment and maintaining price stability, which helps manage inflation. Their decisions ripple across all global financial markets, and the primary tool is using the funds rates. This is the target rate for commercial banks lending reserves to each other overnight. By raising or lowering this rate, the Fed influences the entire economy's borrowing cost from mortgage rates to business loans. Let's talk about a rate hike, right? Tightening. It makes borrowing more expensive, and it slows down the economy and cools inflations, and this generally hurts risk assets. And rate cuts, it makes borrowing cheap, stimulates spending and investment, and this generally favors risk assets. And the secondary tool involved into it, quantitative easing and tightening. These involve open market operations where the Fed buys or sells government bonds to expand or contract its balance sheet. Okay, so we're going to go ahead and keep understanding certain implementations and why Fed cuts are going to be important. And to understand that importance, let's talk about the DXY. The US dollar index, also known as the DXY, measures the value of the US dollar against a basket of 6 major world currencies: the euro, the yen, pound, etc. And because the USD is the world's primary reserve currency, its strength dictates global capital flows. And the inverse correlation mechanism, Bitcoin, BTC, and the DXY often exhibit a strong negative correlation. When the US dollar strengthens, DXY rises, and risk assets like crypto and sometimes stocks tend to fall, and vice versa. And why does the inverse move occur in the first place? A stronger dollar often results from higher US interest rates, and higher rates make safe haven assets like US Treasury bonds, for example, much more attractive, leading investors to sell off riskier non-yielding assets such as Bitcoin or other cryptocurrencies to move capital into dollar-denominated stability. This is known as a risk-off move, so people can plant their money in a less volatile environment. And USD and global liquidity. Since much of the world's trade, debt, and finance is denominated in US dollars, a strong dollar effectively tightens global financial conditions, reducing the total amount of available capital for speculative investments globally. So, how well the US dollar is doing and how high inflation is really going to correlate to everything, such as crypto. And taking a look at the DXY is going to be a nice way to navigate and understand where the economy is at as far as the US dollar. And with all this, it can have a significant impact on crypto. As a high growth, non-yielding, and historically volatile asset class, crypto is highly sensitive to the cost of money and general market risk appetite. And rising rates, right, during the tightening cycle. Higher interest rates hurt crypto in several ways. A higher discount rate is going to be one of them. Future cash flows for growth stocks and projects are valued less in the present. And a yield competitor. Safer assets like bonds start offering attractive yields, pulling capital away from speculative assets so people can have more of that definitive, stable income. And credit contraction. Borrowing costs for institutions and exchanges increase, discouraging leverage trading. So people are not going to be able to make money as rapidly, but they're going to have their money implanted more of like a seed within a stable position. So not looking to quickly leverage trade based off a high and a low or a short and long scenario, but it's more of a scenario of, okay, I'm going to be making this investment with the idea of holding this for decades and years and years and years. And falling rates, this helps ease the cycle. Lower rates are typically a tailwind for crypto, and it increases liquidity. It includes cheaper borrowing, and it injects capital into the financial system, with some flowing into risk asset. It also involves lower opportunity costs. Bond yields become less attractive, which force investors to seek higher returns in growth sectors. and a weakened dollar happens when rates fall. And it often accompanies rate cuts, making Bitcoin, which is a digital gold, which people like to call it, relatively more attractive as a hedge. In the balance sheet, understanding this is going to be extremely important, and quantitative tightening is a policy that's frequently deployed alongside rate hikes. It directly reduces liquidity by shrinking the central bank's balance sheet, creating a powerful headwind for risk assets. And how quantitative tightening works in the first place. The Fed first reduces its holding of treasury bonds and mortgage-backed securities by allowing them to mature without reinvesting the proceeds. And this effectively removes cash from the banking system, which achieves several outcomes. One, reduces the money supply. It directly pulls liquidity out of the broader financial ecosystem, and it increases the bond supply, which floods the market with more bonds, which requires higher yields to attract buyers, driven up long-term interest rates. And quantitative tightening's direct impact on cryptocurrency. Since cryptocurrency thrives on liquidity and risk appetite, quantitative tightening is a major negative factor. And historically, periods of aggressive QT have coincided with significant drawdowns in the Bitcoin and altcoin markets. Less money circulating means less capital available to flow into speculative digital assets. And the word speculative, it's pretty much meaning where you're trying to make money based off directional bias. If you think something's going to go in an upwards direction or in a downwards direction. And crypto's evolving macro relationship. So while Bitcoin was once seen as totally uncorrelated, its relationship with macro forces has evolved due to the increased institutionalization. So the institutional factor, right, with major hedge funds, asset managers, and spot ETFs holding Bitcoin, institutional investors, and now even the US government, for example, treat it similar to high beta tech stocks. When they face the risk-off macro environment, they sell both their tech stocks and their crypto holdings, increasing the short-term correlation and holding cash. And partial hedge thesis, right? Despite the short-term volatility, some analysts suggest that over a longer time horizon, maybe over a course of 180 days, Bitcoin's correlation with the DXY often vanishes, indicating that it can still act as a partial hedge against dollar market-driven fluctuations. Okay, so while the US dollar is weak in certain scenarios, there's a strong chance where Bitcoin can remain strong due to the fact that it's a decentralized currency and takes itself out of the whole fiat currency pool. And some key macros to watch, right? Take a look at CPI. You guys can go to forexfactory.com or any other news website to see some news. Take a look at the CPI, right? CPI and the PCE are going to be really important inflation data numbers to pay attention to. It signals the Fed's next move, and typically after CPI and PPI happens, the market makes a drastic move a lot of the time, since people are going to know how to move. So if rates get cut in certain ways, people are going to know how to invest, and then you might see market get extremely bullish after CPI. So if you're going to make a super big investment, whether it be in a cryptocurrency, stock, whatever, wait for CPI to happen, wait for certain earnings to happen, and then see how the market reacts, and then you can make your decision a lot more logically based off of that. So the DXY is also going to be a great macro to check out too. It's an indicator of the dollar strength in capital global flows. And check out the Fed balance sheet. It tracks the velocity of quantitative tightening in QE. So everything together is really going to help you put together a good thesis and know when is a good time to buy. And as of recently, we've been trading in a much more mature market when it comes to the cryptocurrency space. The cryptocurrency market is no longer isolated. It's intrinsically linked to the global economy. If you check out SPX or the S&P 500 and you pull up the Bitcoin chart, you'll see certain correlations, which is definitely going to let us know that it's classified as a high value asset. So it's intrinsically linked to the global economy, making the Federal Reserve policy the single most powerful external driver of market direction, especially as governments get more control over it and things like that. In understanding the Fed's tools, the rates, quantitative tightening, QE, it's all essential for interpreting market shifts and when market is going to be bullish, which is when market is going in upwards direction, or bearish, which is when you think market's going to go in a downwards direction. And particularly the inverse relationship between the strength of the US dollar, the DXY, and the appetite for high risk, high reward digital assets can have some things you can look at to let you know when it is ready to buy on either sides. So stay prayed up to God, keep grinding. Head over to StackMODE.net if you want to learn how to trade cryptocurrency. I'll catch you guys in the next one. Let me know what you thought in the comments below.